Hello and welcome back to Dividend Destiny, the home of international income investing. Today we're going to talk about mortgages versus REITs, or real estate investment trusts. Lots of people we encounter in day-to-day life express a desire to own a home, a wish that sounds perfectly acceptable when taken at face value. Home ownership has long been viewed as a marker of adulthood and success. But what this means in real terms is that they intend to put a deposit down on a property of around £30,000. Let's use the UK as an example. Put down a deposit of £30,000 and borrow the remaining £200,000 and tie themselves into a contract for 30 years, based on the current conventions and average house price assumptions in the UK. The perceived wisdom of taking on a mortgage for this length of time, as opposed to buying a home outright eventually, has irked us for quite a while. Firstly, by taking on a mortgage, the bank owns the home, not you. Many people believe that they are building equity in a property by making their monthly payments, but in reality they are paying off interest for the first 15 years of the mortgage or so. If a mortgage is used to fund a buy-to-let, the owner must contend with an overvalued housing market, tax implications, and myriad rules and regulations. The dream of owning a home has historically been cultivated by banks and financial institutions because it makes them money. If your objective is to buy property for investment, I would strongly argue that it is much better to purchase a real estate investment trust, or a REIT, and let the landlord do the work for you. A REIT is basically a property trust that owns real estate in a specific sector, for instance residential buildings, offices, hotels, warehouses, shops, self-storage, data centres, retirement facilities, and so on. The property portfolio is managed on shareholders' behalf and the rent collected from tenants each month. A so-called registered REIT will distribute around 90% of this income to shareholders of the REIT. This is decreed by law. They are literally compelled to pay you as the investor. Therefore, I would propose that it is far better to gain exposure to the property market using REITs, build your assets and cash flows, let the landlord deal with the headaches of property management while you sit back and collect monthly or quarterly passive income. Many REITs in the UK and elsewhere are trading at discounts to book value and offer high dividend yields, 6 to 9%, with attractive dividend growth rates. If the property market goes up, the net asset value of the REIT will also go up, allowing you to participate in the capital appreciation of the portfolio if you sell the stock. Then, later on, if you sell the shares at a capital gain, if the shares are in a tax-free or tax-sheltered savings account, investment account, you won't have to pay any of the capital gains taxes. In this scenario, the impact of opportunity cost is quite clear. On the one hand, you can spend 30 years of your life to pay 2 or 3 times more than a house is worth, at an interest rate that is subject to change on the whims of a central bank. Alternatively, you may instead plough your spare income into REIT portfolios around the world and collect truly passive income, then buy your dream house for cash one day when you are financially abundant. To illustrate this concept, the present Bank of England base rate is 0.75%. A prominent high street building society in the UK has a base mortgage rate of 2.75%, and they assert that this will never be more than 2% above the Bank of England rate. Their standard mortgage rate at present is 4.24%. Assuming you get a mortgage on a house of average price, 230 grand, with a 10% deposit, 23 grand, this leaves 207,000 to pay, or around £1,017 per month for 30 years. The amount of interest you would pay over those 30 years would amount to £159,106, or 45% of the property value. Therefore, the house would need to increase in value by 45% to justify the cost of locking yourself into the mortgage. Of course, this assumes that interest rates remain the same. Hopefully they don't go up, and the housing market doesn't fall through the floor like it did in 2008, otherwise you'll be in negative equity. Conversely, we could instead take the 23 grand deposit and invest it in a suitable REIT portfolio, diversified by sector and geography for an example yield of around 7%, in a tax-sheltered account over the same amount of time with income reinvestment. The deposit would grow in excess of £500,000 and be throwing off £35,000 in annual income based on dividend growth of 4% per year. If you paid in £10,000 per year on top of this income reinvestment, the principal will swell to around £2.6 million after 30 years, paying out £183,000 each year in dividends. That's life-changing money. Equally as important is the fact that in doing this, you avoid a costly liability over the period and maintain a significant degree of freedom and independence. Thanks for listening to that analysis. Do tune in next time for more videos on Dividend Destiny.